As an investor, you're always stuck between two massive pitfalls, right? You've got the great deal that turns out to be a company in a total free fall, and then you have the amazing company that's so expensive the train has already left the station. Well, in this explainer, we're going to hunt for that perfect sweet spot, right in the middle. It's this classic investor dilemma. On one side, you have the value trap. It looks so tempting, so cheap, but it's cheap for a really, really good reason. And on the other side, the overpriced darling, a fantastic business that everybody already knows about, which means you're paying a huge premium and are probably the last one to the party. The real magic, though, the truly rare finds, they live right here, at the intersection of those two worlds. We're looking for companies that are not just cheap, but also fundamentally strong. This is where the market has gotten it completely wrong, pricing a great business like it's a bad one.
Okay, that all sounds great in theory, doesn't it? But to actually make this work, you can't just go with a gut feeling. You need to be methodical. So the big question is, how do you define cheap and strong with actual hard numbers?
So for cheap, we're going way beyond just a simple metric like a low PE ratio. We use what's called a reverse discounted cash flow model. Now, instead of us guessing at future growth to get a price, this model does the opposite. It looks at today's stock price and works backward to tell us the exact growth rate the market is pricing in. If that number is ridiculously low, well, we might just have a cheap stock on our hands.
And what about strong? Well, this is a two-part test. First, we need a Piotroski F-Score of 7 or higher. Think of this as a momentum score for the company's fundamentals. It tells us things are actively getting better. And second, we need a health score over 50. This is our check on the company's current quality. Is it profitable? Is it financially sound? You need both to pass this test.
All right, so we've got our strict definitions locked in. Now for the fun part. Let's put this screen to the test and see what happens when we pour the entire market through this funnel.
We're starting with a massive pool, over 2,200 US stocks. Basically, the entire market is going into the top of our funnel. Okay, first filter. Let's apply our definition of cheap and also make sure these are sizable companies with a market cap over $1 billion. And boom, just like that, we've already eliminated more than 3/4 of the market. We're down to just under 500 companies.
Now this is where it gets really interesting. We apply our first quality filter, that Piotroski F-Score of 7 or higher. Remember, this finds companies whose fundamentals are improving. And look at that. We just slashed the list again, all the way down to 153.
Next up, our second layer of quality. We filter for an overall health score above 50. We're now left with just 96 companies that are not only cheap, but also in solid financial shape right now.
And for the final cut, we apply our very strictest criteria. Out of that initial universe of over 2,000 stocks, only 15 make it all the way through. These are the ones we call the gems. They passed every single test for value, quality, and improving momentum.
So, who are these elite 15? Let's zoom in on a couple of them because this is where it gets fascinating. Behind all these numbers, there's always a story.
First up, a name you definitely know, Adobe. Now, I know what you're thinking. Adobe, isn't that a high-quality but super expensive growth stock? Well, that's the common story. The data, however, tells us something very different.
Just look at these numbers. The health score is a fantastic 75. Its return on invested capital is nearly 39%. That's incredible. It's got a solid F-score of 7. And here's the kicker. The model shows a potential upside of almost 89%. So what's going on?
The story is fear. The market is terrified that new AI tools are going to disrupt Adobe's business. That fear has pushed the stock price down into undervalued territory, even though the company's financials are still rock solid. This is a perfect example of market sentiment creating a potential opportunity in a top-tier company. All right, next let's look at another well-known company, but one with a very different recent history. PayPal, the fallen fintech darling. For the last few years, the narrative around PayPal has been pretty negative, right? But our screen is picking up something else entirely. It sees a healthy business, a solid F-score of 7, which means things are improving, and it's calculating a potential upside of nearly 60%.
And here's the key insight. The stock price seems to have fully priced in all that negative sentiment. But while the market was panicking, the actual business has been quietly getting stronger and compounding its value. Our screen spotted that disconnect between the gloomy story and the improving data.
Now check this out, because this is a really important and kind of counterintuitive discovery from the data. You'd think that the absolute cheapest stocks, the ones in deep value, would be the best place to hunt. But look, on average, they actually have the lowest quality scores. This right here is the value trap in chart form. It shows you exactly why just buying cheap isn't enough. You absolutely need that quality filter.
Okay, so you've seen the process. You've seen some of the results. How do you actually take an analysis like this and put it to work for yourself?
Look, the most critical thing to remember is that a list like this is not a buy list. It's a starting point for your own research. The first step is to dig in and figure out why a great company is on sale. Is it a temporary panic, like with Adobe, or something more serious? And then you have to keep checking in. Monitor that F-score every quarter to make sure the business is still on the right track.
So, if there's one thing to take away from all this, it's this. Stop looking for just the cheapest stocks. The real magic happens at the intersection of deep value and high quality. Now, of course, we have to be realistic. A model's upside is just an educated guess, not a guarantee. And sometimes, cheap stocks can stay cheap for a lot longer than you'd expect.
All of this powerful data-driven work, the funnel, the scores, the analysis, it was all powered by the fffinstill platform. It's what allowed us to cut through the noise and find these 15 potential gems hidden in the market.
And you can actually go explore this data for yourself, along with over 300 other free learning concepts right on the fffinstill site. If you enjoyed this deep dive, make sure you follow us for more data-driven explainers just like this one. Thanks for watching.